Done. Acha, Abhi, now you
Good
start
evening.
presenting.
Okay, good evening. This is Anshuman Bhasin, the secretary of the Sundarbans House, and I'm co-hosting this event with Celine Sajji, who is the secretary of the Finance Club, and we just had a brief chat about the investment management industry and the investment banking industry. And now we are going to continue our chat about stock market indices. Okay, so let me present my screen. Cool. So again, S&P 500, what do you guys think? Long term, is it like is it up, down, or does it fluctuate? Long term graph, what does it look like? What do you
What do
guys
you guys
think?
think? Up.
Up. Yep,
Yep,
exactly,
exactly.
exactly. So it goes up, and
And
basically
basically,
what guys, anyone who's not speaking, just mute yourself. Thank you. Yeah. So basically, what Warren Buffett says and what Charlie Munger says, that 99% of people, all right, because again, like I told you, most hedge fund and mutual fund managers do not beat the market. That is, they do not get a 10% annual return, and on top of that, they have their annual management fees, they have their performance fees, they have a fees when you put your money in, they have a fees when you take your money out, and on top of that, you have to pay taxes. It's almost never worth it to put your money in a mutual fund. The mutual fund industry is a giant scam. All right. You, after all of those fees, you might actually end up losing money than gaining money in pure inflation terms. Now, let me tell you guys about this really interesting stat. All right. So, the greatest mutual fund manager of all time was Peter Lynch. All right. Was in the sense he's no longer active in the industry. He's still alive. Okay. But he quit managing money. Okay. So he was the fund manager of Fidelity Magellan Fund, which is the greatest mutual fund of all time, because it was, while being America's biggest mutual fund, it was also the fund that produced the greatest returns. All right. It returned 29.2% for its annual returns for the entirety of its existence, which is amazing. 29.2 annual returns are just crazy. But then, do you know how much the average investor in the fund made? And this is nothing related to the fees and all. When you're making like 30% a year, you can take all kinds of fees, you'll still make money. All right. The average investor in that fund actually lost 11% CAGR. And the reason for that was they were piling in when the fund was at all-time highs, and they were cashing out when the fund went down. All right. So the average investor, even with the best mutual fund manager in history, actually ended up losing money. So all of these factors combined, one, the investor psychology, human psychology of basically buying high and selling low. All right. Human psychology, the investor psychology, the annual management fees, the performance fees. All right. And the fees they charge when you cash out, and on top of that, the taxes. All right. Combine all of these factors, and also the fact that 90% of hedge fund or mutual fund managers do not beat the market, it is almost never worth it to put your money in any mutual fund. All right. Never do that. All right. So what should be done instead? What should be done instead is what Warren Buffett says: put your money in a low cost index fund. So a low cost index fund is, you can go to the ticker VOO. Let's see.
Anshuman, are you changing slides or changing windows?
Yeah. I'm gonna share the I'm changing the tab. Okay, so you
Okay.
guys see the new tab, right? So we go to the ticker VOO, and again, it is not a company. It is just Vanguard 500 index, and it basically tracks the S&P 500. So if you notice, both of their graphs. I'll share this once again. Okay, if you notice their graphs, they are exactly the same. Okay, because this tracks the S&P 500, and also on top of that, it has an expense ratio, which means like if you give your money to Vanguard, they're not going to do it for free, but they do it for a certain fee, which is I think 0.01%. And that is amazing. That is amazing because your average hedge fund manager is going to charge you 2% annual management fees, 2%, like above 6%, they might charge you like a 25% performance fee. So those fees are really high, and again, like all of those factors that I mentioned, combined, those, you actually might end up losing money putting your money into a mutual fund. So what you do instead is that you put your money into the S&P 500 VOO, and there are many others. There's a Fidelity one also, but then let's talk about the Vanguard one for a second. So Vanguard Group was basically started by this amazing guy. His name was Jack Bogle. Hold on, let me show you guys his old wrinkly face. Wait. Okay, so this guy basically started Vanguard Group, and he basically changed lives for retail investors around the world. All right, okay, this guy, he died very recently, and Warren Buffett, of course, considers him a legend because the average Joe no longer has to, or the average Joel no longer has to give their money to a mutual fund manager who's going to charge exorbitant fees and give subpar returns. All right. So this guy, he started this company, the Vanguard Group, and he started this thing, the S&P 500 index fund. All right, this index fund he invented, and that basically allows you to basically buy a piece of America and bet on America's success and continue to hold it for decades, adding to it monthly and for your entire career, and then of course like allowing the magic of compounding to work. So yeah, uh, in the entire investment industry, all right, he is one of the few people that almost everyone regards with a lot of respect. So like if you take an institution like, say for example, a Goldman Sachs or a JP Morgan or a Citibank, a lot of people don't have respect for them because people blame them for engineering the 2008 financial crisis. All right. So not getting into how much they were personally to blame for it, but this man is universally regarded and loved in the entire investment industry. And yeah, okay, so let us also talk about how the investment industry in terms of incentives work. So usually a lot of people in these investment banks work in the capacity of financial advisors slash stockbrokers. So what they basically do is they have a rich client, they call him up, they say, hey, you know what, you got to buy this stock, you got to buy that stock, just like you guys have seen Wolf of Wall Street, right? So basically that stockbroker, all right, like they very correctly pointed out in that film, his incentive is to make a commission. Okay, he makes a commission only when you buy or sell. All right. So that guy basically does not give a fuck if you make money or if you lose money. All right. He just has to keep, he just wants to keep make you trading in and out. All right. So and also sometimes a lot of these financial firms are paid for promoting certain stocks which they are themselves underwriting, or they've gotten, like they've done some under the table shady deal to promote a certain stock to pump it all the way up. And although like the Securities and Exchange Commission has been cracking down, and it doesn't happen as often, that sort of market manipulation, but then still a stockbroker only makes money if you buy or if you sell. So if he wants to maximize his income, what he wants you to do is keep on buying and keep on selling. Okay. So but when you're buying, again, you pay a commission. When you sell, you again pay your fees to cash out, and then whatever that trade was, you pay taxes on that. And it's not a very efficient way to make money, and in fact, like I pointed out, most people will never make money that way. Lots of dentists across America have lost their fortunes to financial advisors or stockbrokers in this fashion. Okay, so like I just pointed out a while ago, all you got to do is buy a low cost index fund, and it takes you it allows you to buy a piece of America. And yeah, so like I said, these are weighted indices. So anytime a company is bigger, like a company is rising on the charts, they readjust, they sell a certain portion of another stock. And like I mentioned, all the buying and selling is done by these guys. You don't have to do anything, you just have to buy, all right, and just hold. All right, so let's just see how what it has looked like for the past 5 years. All right, 5 years ago the S&P was at 2000, and now it's at 4700. All right, so that's like a 101, like 100 close to 100% return. All right, so that's like doubling your money in 5 years. All right, so if 5 years ago you'd bought, let's actually go to VO again. 5 years, okay. The same, the numbers are different, but then it's like the same percentage gain. All right, so 5 years ago you buy VO, all right, at 200 USD, and now it's 431 USD, and it's close to 100% return, like 114, just like it was on the S&P stock index. So you buy it, and then like, okay, like it does not necessarily have to double every 5 years, but then historically it returns 10%, 10 to 12% a year. It looks like that. And yeah, so the smartest thing for 99% of people on any finance club, on any like Discord chat where people talk about trading and all, is basically not to listen to any of that nonsense and just buy a low cost index fund and keep on adding to that throughout your career. All right, and of course, if you are interested in investing, and you do like to look at if you do like to look at financials, and you do like to analyze companies, then of course you shouldn't. I mean, if you think and if you actually have a talent for it, then like pick individual stocks. Otherwise, it's pretty like risky for the average person to pick individual stocks. And in fact, there was a study where they had this gorilla throwing darts and at stocks, basically. And that gorilla was basically just doing as well as the average hedge fund slash mutual fund manager was. So that was like really surprising. So like the academia thought that so that led the academia to create this theory, which is, by the way, a false theory. This theory called the efficient market hypothesis, which means that no one can ever make money in the markets, and if you do, it's just by happenstance, it's just by luck. And of course, great investors have been proving that theory wrong forever. But then there's this really great investor, like this guy named Ed Thorpe. All right, so this guy basically was an MIT professor. This guy basically invented card counting. So you know that movie 21. So all of that is basically based on his work. All right, so he invented card counting. This guy taught the world how to beat blackjack, beat the casino at blackjack. And then he also made this like this wrist contraption that tracked the roulette ball, and this guy was also able to beat roulette, which is like wow, amazing. So when this guy made a small fortune in the casino, he's like, okay, let me try the bigger casino, which is the stock market. All right, and the stock market is a casino for in the sense that it is a zero sum game. All right, if you are making money in the stock market, someone else is losing money. All right, that is especially true if you are trading. All right, it is a zero sum game. And like Warren Buffett says, the stock market is just an instrument that takes money from the impatient and gives it to the more patient. So again, like if you're like a long term S&P 500 investor, you're obviously going to make money. It's a no brainer. Whereas the traders who think, okay, Tesla is going to go up 10% tomorrow, are going to lose money. Those guys. Okay, so this guy, he had something very interesting to say about the efficient market hypothesis. And that was, he said, the efficient market hypothesis is definitely false, but you should take it to be true for yourself unless you have evidence that it is false. Which means, okay, I'm talking to how many people? 9 people, right? So let's say it was 10 people. Okay, actually, okay, no offense to anyone. Let's just say I was addressing a crowd of 100 people. Okay, 99 of those people do not necessarily have a talent for making money in the stock market. Okay, so but then if you still want to make money, what you need to do is put your money into a low cost index fund, and you will beat the average person trying to beat the market. All right, you're not going to beat that one guy who's super talented and actually is has a great business acumen, but then you're going to beat everyone else who's going to keep on trying with like trading or like stock picking, any of those activities. All right. So there are some questions in the chat, so I'll take them. So Joel asks, how about Small Case? So Small Case is an Indian company that allows you to buy funds, right? If I'm not wrong.
Yes, but as you said recently about the low cost index funds, they have
Yes.
so from I'm not sure if I'm right. I've just read about it recently, but what I've seen is they have made something similar to this. So like they have done some analysis on the stock market and they have made some packages of stocks.
Yeah, actually, okay. Can you mute yourself? Yeah, thanks. Yeah, so actually, I have a distant, you can say, cousin. Okay, his name is Arun Mehra. He is the fund manager at VC Investments in London, and he actually has his fund listed on Small Case. And yeah, so it's like there are lots of people offering their particular fund on Small Case, and then Small Case is basically handling the distribution end of it. Like like a Fidelity can actually put up offices everywhere, spend money on marketing and make people buy into their fund. So Small Case, or what they're doing is that any of these financial firms can list their funds and people can buy it. So yeah, some of those funds are decent, but then again, like, just because a certain fund manager on Small Case, like let's say you're interested in some fund called, let's say, XYZ. Okay, so XYZ fund, you see, has returned like a 30% CAGR for like 3 or 4 years. Okay, it's not necessary that that performance is going to continue. Okay, and especially when people see that performance and more people buy into it, there are growing pains, in the sense that the it's a general principle in finance. The larger the amount of money you're managing, the lower your returns are going to be. All right, so if you're managing very small amounts of money, you can make great returns on it. But then when you're managing really large amounts of money, you cannot necessarily replicate those incredible returns, because you can no longer look at the under observed or the under analyzed micro cap, mid cap stocks. All right, so uh, and also, again, like just because your that hedge fund manager you see has on Small Case has returned like 30% a year, something like that, has done that, it could totally be a fluke. All right, And also, like Warren Buffett correctly points out, you only find out who's been swimming naked when the tide goes out. All right. So when actually shit hits the fan, that's when you see who's like a genuine vetted money manager and who's just been having like a lucky streak. Okay. So any question on that? Okay. Can you also explain about IPOs and also about Star Health Insurance? Okay. And Murtuza says, I guess it was monkey to put bananas. What are you trying to say, Murtuza? I'm not able to get you. Do you want to say something? Cool, we'll move on. What theory? Okay. The gorilla like throwing darts, right? Huh, okay. Okay, can you explain about IPOs and also about Star Health Insurance's IPO? Okay, so an IPO is basically
Excuse
an
me.
initial. Yeah, Ritam is
Before
trying to
the
say something.
before we go to IPO, I have a doubt. I mean, I think two doubts. First, our is Nifty 50. The Nifty 50 is, you said, we know it tracks the top 50 companies of BSE or NSE, and obviously it will be an upward chart, like as year goes on. So I have a doubt, means it could be a foolish one. Like, is Nifty 50, that rating, that 17,000, is that a point? Or like for any stock that we have some like valuation of stock like 50 rupees, 30 rupees, is that a some 70,000 rupees of that Nifty 50?
No, it's just a composite number that they arrive at. It could be anything. Just like we saw VO and S&P, right? They were different
Yes.
numbers, but then it was the same percentage gain. So like 17,000 की जगह वो like 1,700 भी कर सकते थे. Okay.
Okay, no,
Wait, hold on.
I meant to
Let me
ask
see.
that, can we buy that Nifty 50 or something and keep it like 10 years and see what is the return or something?
Yeah. You can do that. You can do that. Do you use Zerodha or something like that?
No. I haven't installed in, apart from Grow, I haven't installed any kind of app or. Oh, Zerodha
Okay.
is
So just
not an app, I think.
It is
what?
an app.
Oh, it is an app. Okay.
I think you can buy stocks on Grow also, no?
Yeah. We can.
Yeah. So okay. So
Not
Ritam
necessarily
is
you
saying
use
you have Grow.
Zerodha.
Ritam, you have Grow, right? That's what
Mm,
you're saying?
I've just installed it like 10 to 12 days back. I haven't actually
Yeah.
registered with PAN card and bank account. But yeah.
Yeah, so on the search, just type Nifty 50 and you'll find lots of options. I think there'll be one by Tata Capital, there will be one by like all of these financial firms, and just identify which one has the lowest expense ratio, and you can buy that.
Lowest
One
expense
problem.
ratio is like over here is written open, high, low,
No.
LTV, last
No.
traded
Just
price.
like you can do just a quick Google search,
Yes, that's what I
which
mean.
Nifty 50 index fund has the lowest expense ratio, which means
Oh,
how much
okay.
they're going to charge you for managing your money. Okay, it's usually 0.0 something. It's never like a very large
Which
amount of money.
Nifty 50 stock has the
Okay, let me do
lowest?
that for you.
Okay, you can.
Okay. Okay. So where you guys can see it, right? So I just searched
Yes.
it. Which index fund has the lowest? Yeah. So we see here the Motilal Oswal Nifty 50 index fund has an expense ratio of 0.1. So that looks pretty good.
So it's like
Motilal Oswal. Yeah. Tell me.
it's like I buy rupees, that suppose that stock is for rupees 500, and I bought two
Yeah.
stock 1000, and after I sell it after some years or months, they are gonna charge 0.1% of it.
Yeah. I know actually
And
they're going to. I think they charge that annually. That amount of money,
oh,
expense
okay.
ratio. Yeah, but then it's not a significant amount of money. It's not
Yes,
even one
yes,
percent of your capital, so it
yes.
doesn't matter.
And another
Okay,
question
so,
is that, like, suppose I have a stock which is, suppose I've invested a lot of money in a stock, and that has given me lot huge return. For example, I invested 1 lakh and I'm getting 5 lakh after a couple of years, and then I decided to sell it. So upon selling it, will I be subjected to some tax, like government of India, some income tax? So
yes,
would it,
yes, sure, sure.
would
Okay,
I-
let me explain that to you. So what is your holding period? How long have you held that stock? Your example stock.
like 6 years?
Okay, 6 years is a very long period of time. So usually there are two kinds of taxes on securities. There is a short-term capital gains tax and there's a long-term capital gains tax. In general, stocks may it's a capital gains tax. Okay, so the long-term capital gains tax kicks in uh, at the 1 year mark. All right, so if you've held a stock for more than 1 year, long-term capital gains tax is applied on it. Okay, and so for any gains between 0 to 1 lakh, the tax is zero. Okay, 0% tax, and for any gains above 1 lakh, it is taxed at 10%. So your example stock, what did you say you bought it for, and how much did you say you sold it
This is an
for?
hypothetical situation. Like I bought it
Yeah, yeah,
for,
absolutely.
oh, like for example, I bought it for 1 lakh, and after 5 to 6, it becomes 6 lakh. Just saying. So,
Yeah.
so then after that, 10% will be charged, which is like 60,000.
No. So let's do the calculation. You bought it for 1 lakh. It became
Yes.
6 lakhs.
Yeah.
Yeah.
Yes.
So it became 6 lakhs. You had originally bought it for 1 lakh. So your capital gains is 5 lakh rupees. Okay. So that's your capital gains, which is what you sold it for minus what you bought it for. Okay.
Got it.
Now
Yes.
on the 5 lakhs, on the first lakh there is no tax. Okay. No
Okay.
tax on the first lakh.
So for remaining
Now
4 lakh.
yeah, so 1 lakh you get for free. Okay, no
Yes.
tax. Now 4 lakh remains. Okay, now on 4 lakhs, hold on 4 lakhs you have to pay 10% tax.
So forty
Okay,
thousand.
so that becomes 40,000. So after 6 years, 1 lakh to it becomes 6 lakhs. You pay 40,000 in taxes.
Okay. And it will be deducted automatically, or do I need to?
No. You have to file your tax return. Okay,
Okay. Okay.
and you have to declare it. You have to declare that you bought it and you sold it. It is not deducted. What is deducted automatically is your dividend. So let's say, for example, a certain you've bought a certain company that pays out dividend. Okay,
Hmm.
so that company is supposed to deduct a 25% TDS, and that's already tax is already deducted on dividend. You don't have to worry about filing the dividend in your
Okay.
tax
Okay.
returns.
Okay. Thank you. I got
Yeah,
it.
so continuing with your question, so and yeah, Navi is a pretty good company. It's a startup by that Flipkart guy, that Bansal guy. So Navi Nifty 50 index pretty good. Very low expense ratio. Look, it has
Zero point zero
0.06.
six.
Yeah. So you might want to buy this. This is like a pretty. This is better than 0.1%.
Yeah.
Although कुछ ज़्यादा फर्क नहीं पड़ता. But then if you're holding it for decades, it could mean a lot of money. So yeah. So definitely go for this. So definitely go for the Navi Nifty 50 index. And I think I don't know if the Navi Nifty 50 index would be listed on any of these apps. You might want to download their own app and then buy it. You can again just Google, find out how to buy it, and just buy it. And yeah, you all you have to do is just when you're finally selling it, you have to declare how much you put in originally and how much you're taking out now, and then just like taking out the difference. Yeah.
Okay. Okay. Thank you. I got it.
Okay. So there is yeah. Okay, so Joel asked about Star Health Insurance. Okay, so Star Health Insurance, as far as I know, a decent company. It was like formed after the merger of Star and Alliance Insurance, and it has like a 15% market share in the insurance market in India. So it has a pretty good standing. And yeah, insurance is a pretty great business if your money is managed well. Like if good things are done with that investment float, like insurance is a very good company to be in. Warren Buffett rightly chooses to be in businesses like Geico and General Re, which just give him insurance float to invest, which is really great. And yeah, so I about buying on IPO, I recommend against it, because like Kritam asked last time about so basically, like what you expect in the IPO, what you expect to happen in the IPO is like, sorry, Burger King India. Yeah. So what do you expect to happen in an IPO is that I mean, at least these days, in India, like people think that they can buy at IPO price, sell at a profit, and then make a killing, and that does not necessarily have to happen. Okay, so again, just looking at the day it got listed, started at 157. All right, went down, went all the way down, went all the way down, and then again, like it's not necessary that a stock will take off immediately after IPO. Okay, and you whatever price and whatever evaluation, whatever valuation you ascribe that company to, you wait, and then you allow the stock to dip to a certain price where you think like right now it's a bargain, and then you buy. Usually IPOs are either fully priced or overpriced, so I don't recommend buying IPOs. So yeah, we can guide him personally later, I guess, will be more good.
Can you also
What?
explain about like how to invest in these index funds in India, especially in India?
Yeah, good question. Yeah, so j- I personally don't do index fund investing, but then again, like you can open up your Zerodha, and you can just type in Nifty 50, Nifty 100, and all of these options will turn up, and you can pick any of those, and then buy any of those, and then just keep adding to them over time. And like yeah, Murtaza has a question.
Didn't we just said that right now?
How, what?
I guess the same doubt was asked right now.
Okay, you have something to say?
I'm saying the same thing was asked right now.
He's asking me about how people. Can you mute yourself? Yeah. Yeah, so it's okay if he wants a little refresher. And anyway, what the earlier question was, like about how what particular thing can be done, and what the lowest expense ratio is. And okay, so anyway, so Joel, you can just go to your Zerodha app or Upstocks or Grow app, and just type in NSE, like Nifty 100, Nifty 50, any of those. You can type Nifty 50, and you'll see a ton of options. Just do your research on which is the one with the lowest expense ratio, and you can buy that one. Okay. And there is also one problem about one problem with investing in uh, index investing in the Indian market. So let me tell you guys what that is. Okay, so let's go to Nifty 50. Okay, so sharing this tab. Okay, so yeah, So the S&P 500 in the last 5 years, it doubled, and then this also doubled. But then in the same duration, the rupee the rupee went down against the US dollar, and the US dollar went up against the rupee. So basically, like, if you're index investing in the US, you basically gain an additional 1 to 2% every year. And so that's always preferable. Like, why not make an extra 1 to 2% every single year? So let me show you guys what it looks like over time. So any growth country that basically wants to promote its exports, and discourage imports. All right, what they basically do is they artificially devalue their own currency. China does it, South Korea does it, Japan does it, India does it. All right, so this is what it looks like. Okay, over time, this is what it looks like. And then if you add to that, like, let's say, for example, a socialist takes power who wants to keep on giving people free money, free services, whatever. Let's say Arvind Kejriwal tomorrow becomes prime minister, and add bad monetary policy to that, add socialism to that, so there's even more devaluation. All right, there's devaluation as it is because it's a growth country, and they want to encourage exports. But then if you add socialism in the mix, it's heavy devaluation. So do not index invest in India. I would highly recommend index investing in the US. So there is, for example, this app called IND Money. So on IND Money, I think you can find VOO, just buy it and hold it. Or if you like paying a monthly fee, IND Money is free. If you like paying a monthly fee, just like get an interactive broker's account and keep adding to your VOO position. So yeah, so that works out. Like, and then another benefit to indexing abroad is that, okay, so for investing abroad, the long term capital gains tax kicks in after 24 months. That is 2 years. Okay, and then after that, what you can do is you can take this thing called the indexation benefit. Okay, so what the indexation benefit is, that it looks at retail inflation. All right, and what it basically does is that like again, things cost more in the future. So the RBI, uh, uh, table for CPI inflation, you can look at that, and then you can say that, okay, from this year when I bought it to this year, there was this much percent inflation. So you can take that indexation benefit and get a percentage off of your capital gains. So that's like really, really, really great. But then just the hassle of investing abroad is a lot. But then, yeah, if you're holding for the long term, doesn't really matter. So, like, just get like IND Money and put in your money into a US index fund. And then it doesn't really matter, like okay, rupees mein. Okay, like since, if let's say, if you really don't want to go through that hassle, let's go to, hold on, let's go to Nifty 50 once again. Let's go to Nifty 50 once again. Here we got it. Okay, so again, so it's a double in rupee terms only. Okay, so what you're losing is in potential dollar converted amount. Okay, so let's say 5 years ago you had 2 lakhs, and 5 years later it becomes 4 lakhs. If that's fine by you, you should definitely index invest in India only. It's much more convenient. There is very low compliance. Whereas if you're buying foreign stocks through IND Money or interactive brokers, it's a very, very high compliance thing. If you don't want to go through the hassle, just index invest in India only. So yeah. Okay, what is the difference between Nifty 50 and Sensex? Okay, so Sensex, the BSC Sensex. Hold on, let me share this tab. So BSC Sensex is a free float market weighted stock market of 30 well established financially ground companies. Okay, so it's the 30 top companies. Okay, and likewise there is a Nifty 100 also. So the Nifty 100 is the top 100, and remember all of these are weighted averages in the sense that the biggest money allocation goes to the top company, the second biggest money allocation goes to the second biggest, and so on. Yeah, cool. Okay.
I have a question. Like, there's a BSC Sensex means top 30 companies. Suppose one, is there any chance like one of the 30 companies suddenly have a downfall and then it changes the overall value of that Sensex?
Yeah. So you don't have to worry about it,
Okay.
because what they basically do is they look at market capitalization, okay,
Hmm.
and whatever the situation is, every day of the year they will be holding the top 30 biggest
Oh
companies in India
yes,
in a
top
weighted
30. Yeah.
index.
They will just
Yeah.
replace
So
it with
so
another. Yes.
exactly. So if TCS goes to zero tomorrow, TCS will just be replaced with another company. All right. Like in the
Yes.
sense that the company that comes after TCS will get the biggest allocation, and then accordingly they'll adjust and they'll induct another company to take the last spot, which is
Okay.
which is the company after the 30th company.
So basically, I can buy BAC Sensex for 57,107 and then hold it on for like 5 years, 10 years, and then I can sell it. And then after that, calculation we did, that will happen, right?
Exactly. And
Okay.
I would suggest don't just I don't know, I'm just a very frugal person. I don't like spending money at all. But I would
Same.
say hold forever. Like if you're index investing, let the magic of compounding work for decades. All right. And like whatever money you make, just stash half of it into a BSC index, or whatever, if you want to do the compliance for an index, and just let it compound without interrupting it, without cashing out, without paying tax.
Yes. Another thing is like, suppose for the earlier example, I made 6 lakh rupees. Then there's the provision to sell 50%, that is 3 lakh, and keep the remaining 3 lakh to again grow for years and years. There is this provision, right?
Yeah, exactly.
Okay. Okay.
But then your long term is just the way compound interest works is that if you had kept the whole amount versus if you had kept half the amount, you'd really wish that you kept the whole amount.
Yeah. No,
So
I'm just asking like that works or not.
yeah. So
Yes.
again, taking the same example, you bought it for 1 lakh. Okay.
Yes.
Let's say you bought two shares worth 50,000 each. Okay.
Hmm.
So some years later, it becomes 6 lakhs. Okay. So now each
Yes.
share is worth 3 lakh. Okay. So
Yes.
now you can sell that one share, and then your capital gains is 3 lakhs minus 50,000, which becomes 2,50,000. For the first 1 lakh, there is no tax. Okay. Now for 1,50,000, there's a 10% tax. So you pay what,
15,000.
15,000. Yeah,
Yes.
exactly.
Okay, got it.
Yeah, cool. Okay, so any more questions?
Oh yes,
Cool,
that
cool.
question. The question is that yeah, that time we had some that operation charge 0.06%, and it will be auto deducted after 1 year, or like how the deduction is gonna work.
In the sense, you don't even have to worry about it. Okay,
Okay.
look, I'll show you. Okay, you go to VO, and again replace VO with NSE, BSC. All right.
Yes, whatever. Just an example.
Okay, whatever. Just all you're doing is, okay, you're buying here and selling here. You do not have to worry about any expense ratio. or anything, that where it is deducted, how it is deducted. They do it themselves. All you have to do is you buy at 200, you sell 425. That's it.
And according to profit and income, I pay the tax. That's it, right?
Yeah,
Yeah.
exactly.
Okay.
uh, you hold it for, of course, longer than 1 year. Long-term capital gains kicks
Yes,
in.
yes.
425 minus 25, and again, you accordingly pay your taxes on that.
I got it.
Cool. Okay, so any more questions?
How does the taxation work on while investing on foreign stocks like the S&P 500 or the VOO?
Yes, sure. So let me show you the table. Hold on. Yeah, let me share this tab. So this is from Clear Tax. It's a pretty good platform if you guys want to file taxes or anything. Okay, so for Indians investing in the US stock market, basically the long term and short term thing basically happens after 24 months or 2 years. So in Indian stock markets, you have to hold it for 1 year, and after that it term capital gains tax, or before that it's a short term capital gains tax. So for investing in the US, for investing in the US, sorry, hold on one second. Yeah, so for investing in the US, it's basically 24 months. All right. So for 24 months, you must continuously hold it. Varna, it's a short-term capital gains tax. So let's go over the original investment first. So on your original investment, basically, that's a 20% rate, whereas in India, 1 year and 10%, and that too above 1 lakh. Okay. And your dividends are taxed at 25%. Okay. Oh, God. Yeah. And it's applicable slab rate in the sense that whatever your income is, whatever your slab of income is, you pay your taxes on your dividends accordingly on that. Okay. And yeah, basically just this dividend thing is like really tricky. But yeah, if you're buying a company that does not pay dividends, you don't have to worry about that. So basically, yeah. So this thing, long-term capital gains tax is 20%, but then you can claim indexation benefit, which really like lowers your tax by a lot, like a lot. Hold on. So RBI CPR table. Yeah. So you guys can see this table, right? So this RBI table basically, there's this is like a monthly table, but then there's this yearly table. Okay. And on that yearly table, what you can say is that, okay, when I bought it, things used to cost this much, now they cost this much, therefore adjust my cost by this much, and therefore you end up paying a lot less in capital gains taxes. So actually it's effectively a lot less than 20%. It's close to, it's a lot closer to 10% or lower. So yeah, but that's like a great advantage, this indexation benefit. And yeah, that's how it's basically done. But there's a lot of compliance, there's lots of forms that need to be filled for this thing. And yeah, if you're a beginner, you're best off investing in the Indian markets only. Very simple tax code, very simple compliance. and hold for long term. And if you're basically I'm assuming since you guys are students, you're basically handling money less than 1 lakh. So if you're handling money less than 1 lakh and your gain is less than 1 lakh, you don't even have to worry about paying any taxes. So like long-term capital gains tax under 1 lakh is basically zero. So you guys don't have to do any sort of compliance. Just buy, hold for 1 year, then sell, and then buy another thing. Or just like I mentioned, just buy an index fund. So that works out. Cool. Any other questions?
You also said about the IND money app. How is that? Is it good?
Yeah, it's a pretty good app. Allows you to buy US stocks. But then again, like when you will face problems when you are selling it, all right? And you'll have to get someone to fill out all of these complicated forms for you. So I have an accountant who does these things, but they're really, really, really complicated. Like you have to fill out like at least 4 different forms for these declarations for foreign stocks. But yeah, if you can probably just buy right now, and if you're thinking of selling like years later, then it's fine. But yeah, it's compliance. It's compliance heavy in terms of if I would just recommend you guys to just be invested in the Indian market for now, if you guys don't want to like pay CAs exorbitant amounts of money. Yes, Celine had a question.
No, if like everyone has, like no one has more questions, so we can wrap up, I think.
Cool. Any more questions, guys?
Through which app or where do you invest in US stock market?
Dude, I do interactive brokers for personal reasons, and the reason is that basically when you buy through commission-free apps, like basically like Zerodha, although I I do invest in India through Zerodha. It's like Zerodha, Robinhood, Grow, all of these. Basically, trading is not free, okay? And
Hmm.
you have to remember, anywhere if anything is given to you for free, it means you are the product, okay? So what these guys basically, how these guys basically make money is that they basically like when you buy something, it's immediately credited to your account, right? But what actually happens is that that trade right now actually hasn't happened. They give it to a market maker, all right? They give it to a hedge fund like Robinhood in the US. They give their order flows to Citadel, and they basically execute those trades for them, okay? So what basically happens is, since the stock market is a game of poker, what these guys are basically doing is they are basically showing Ken Griffin all of your cards, okay? So they're saying, hey, Ken Griffin, pay me some money and I'll allow you to see the cards of all of these young guys, and you get to trade accordingly. So someone who can look at your cards during a game of poker, during a game of bluff, all right, has an upper hand, right? So then Citadel makes exorbitant amounts of money knowing which direction the market is going, knowing which direction, which stock is really popular right now, and doing like a basic trend following trading pattern. They make a lot of money. Okay. So I just use interactive brokers, but you can use IND money. Actually, also IND money is very recent. Interactive brokers has been around for a long time. And then I also personally fear that I don't know, since IND money is just a startup, if it just goes under, uh, what basically happens to my stock? The thing is that in India, if your broker goes under, your stock is still safe. Okay, so in India there are two depositories. There's CDSL and there NSDL. Okay, hold on, or
Full
NDSL.
form.
Let me check that. There's CDSL. Share this tab. Yeah, so there's CDSL, which is the Central Depository Services Limited. Okay, and these guys are basically like a tijori for your stocks. Okay, so CDSL handles the BSC stocks, and let's see, NSDL.
National Stock Exchange.
Yeah, NSDL. And so NSDL basically does it for the NSE stocks. Okay, so these guys, like I said, are basically they're like a safe for your stocks. Okay, so basically what your broker does is that they execute your trade, all right, and then there's a CDSL account of your name which belongs to you, and your stocks, you can say, although there are no longer any physical stock certificates, you can say that they hold that stock in a particular safe. It's actually like a cloud service now, so it's not an actual safe. So they basically hold the stock for you, and if your broker goes broke and it goes under, okay, those stocks still belong to you. Okay, whereas in the US, if your broker goes under, you only have like an insurance of $250,000. So if your broker goes in, you're gone along with it. So yeah,
I see. Interactive brokerage and website. Is it?
yeah. It's a web app and a website.
Okay, yeah, I just saw it now. Okay.
Yeah, but then interactive broker costs money, so you guys can buy on IND money. It's a decent app. It's about it was founded by that same guy who I think founded Go Ibibo and like a bunch of other companies, Make My Trip and all that. Ashish Kashyap guy. So I mean, I have no reason to doubt it so far, but then I'm just still playing it safe.
Okay. And interactive broker is like we need to pay a monthly or yearly subscription or something like
Yeah,
that.
just listen. Don't bother about interactive brokers. I shouldn't have told
No,
you
no, I'm
about it.
just
Just
asking in
yeah,
like
yeah,
how
yeah.
it works. I'm not gonna invest in USA right off the bat in case I do, but just I'm asking how it works.
Yeah, so basically you can try a free trial.
Oh,
You
acha.
can I can give you like a affiliate link, and you can do like a free trial, and yeah, you can.
Okay, I got
But
it.
yeah, just don't do interactive brokers right now. So anyway,
Yes,
so
yes.
like if you're paying your broker a certain amount of money, and you actually losing on you end up losing on your trade, and then on top of that, like let's say you gain a small amount of money and then you have to pay taxes on that. It's just the whole thing is not worth it. So yeah, that's the thing.
So
Okay, cool.
apps like Zerodha, Grow, and similar apps, they're all safe to you use, right?
I use Zerodha. Yeah, yeah.
So do they charge any fees?
No,
Like,
no, no. Zerodha is free. Zerodha is completely free. I think Upstocks and Grow are also completely free. So just Zerodha is the oldest, most trusted in the Indian market. So just don't even worry about it. Use Zerodha. So don't worry
okay,
about it.
okay, thanks.
Yeah, no problem. Cool. So unless there are any more questions, we'll just wrap up. Yeah, no problem. Thank you for joining us, Joel. Okay, so any more
Thank you for joining,
questions?
everyone.
Cool. Okay. Thanks for joining, guys. Good discussion. Not all felt like was a Google search presentation. Totally enjoyed the interaction with everyone with their own views on investing in the part. Yeah. Thanks, Murtaza. Thank you, Ritam.
Thank you, everyone.
Okay. Bye, guys.
Bye,
Bye.
everyone.